hearty welcome to Grandma's Wealth Wisdom with your neighborly hosts, Brandon and Amanda Neely. This is the only podcast that helps you take charge of your cash flow and leverage your assets simply and sustainably, the way Grandma used to.
So there are a lot of people out there with a lot of opinions about whole life insurance. Today, we want to tell you stories about whole life insurance.
And especially our stories.
Our stories, yeah. We've got a few stories. They're kind of the idea behind this is that even people who hate whole life will agree that there are some circumstances that whole life is good for, that they might say, okay, go ahead and look at it, decide if you want to do this. And we're going to kind of tell 3 circumstances that we found ourselves in that made...
That's a lot of circumstances.
Not just us, but members of our family that made whole life made sense. And then we're going to share kind of 3 big red flags of when you want to choose not to do whole life insurance. Okay. So we're going to kind of tell our stories of why we chose it. And then 3 things of why we wouldn't choose it as well. Our experience with whole life started with us personally, and then we're going to talk about 2 other members of our family and why they chose whole life. Not my dad, but actually something that happened after he graduated to the heavens. So Brandon's going to kick us off with our own story.
Yeah, so we are business owners, we're entrepreneurs, and we had a coffee shop with a lot of debts. If anybody says, starting a business is easy, especially a brick and mortar business, in order to start that business, it takes a lot of effort, it takes a lot of energy, it takes a lot of capital to do that. And in all of that, we didn't have rich uncles that just gave us a loan that could say, oh yeah, here's $200,000 and, whatever. We did it on our own. We did it after 2008. So if like back then, getting loans for a business, especially a coffee shop, they want to see history. They want to see all kinds of stuff. And if you're an entrepreneur, guess what? You don't have any history when you start. You have to build it. So we took on a lot of credit card debt, and we were naive entrepreneurs thinking, man, it's gonna turn around in 6 months and we'll be able to pay those.
Right. There was 0% interest for 6 months. We thought, we'll easily have these paid off. Not the case.
No. And then the interest rates started to show up. And
there went all of our profit. Yeah. Anything that we had was going directly to the interest.
And at the same time, we knew we were taking on a lot of risks being an entrepreneur. And I think in our time now, there's going to be a lot more people who are going to be forced into entrepreneurship, not because they want to, but because they lost their job or who knows. So anyway, that's beside the point.
Yeah. I don't think at the time we realized how much risk we were actually taking, but looking back, we took on a lot of risk to get started. And at this certain point, a couple of years in, we got up close and personal with that risk and realized just how on the edge we were.
Mm-hmm. Well, and what we had figured out too was we weren't taking care of ourselves. We weren't setting up a plan for our future. And so we had met a friend of ours who's now a good friend, and said, well, how do we plan for the future? If we know we're taking on a lot of risks, how can we reduce that risk?
Yeah.
And so what is insurance, right?
The definition of insurance is the transfer of risk. And that's what was initially attractive to us about this idea of whole life insurance, was that it could be a transfer of risk. The risk that one of us died, obviously, like the business would have been kaput, right? Without any kind of protection that way. But we could have chosen term life. Brandon, what was appealing to you about whole life in that moment when we realized we were confronted with the risk we were really taking?
I think some was still that idea of saving. We needed to be saving for our future. There was you go and try and get a savings account and see how much interest you can make off of that.
Especially
hardly any.
And including in 2013 when we were making this decision. Yeah.
And so we were like, well, what do we do here? And the idea of building up some cash value in our policy, and that's where it's very different than just a typical whole life policy. We wanted to start building up a reserve,
Yeah.
emergency reserve. And eventually, hopefully, we could use it to pay off some of that credit card debt that we had, or at least lower that to a 5% interest.
Or whatever. Yeah. So a lot of people that are already familiar with whole life, you have all these alarm bells going off saying, no, you can't do that. You can't pay off your credit cards, at least not right away. You got to wait 10 years. How could this be an emergency fund for you? That doesn't make any sense. We want you to just set those aside for a second. We're not going to get into the details here. We're just telling you part of our story. And when we get to the end, or we're at those 3 red flags, we'll get into more of that now. So let your spidey senses kind of simmer for a second. And what we've found as we went on this journey with working with this gentleman that helped us do this, we found we were able to pay off those credit cards in 2.5 years. We had that emergency fund. So when we had a big flood in our business, we were able to get through that and still arrange for that business to be sold, go on a trip to Ireland, all within this like 6-month time frame. And then we had a kid, right? But really for us, there was that getting out of debt part. There was that, or actually becoming better than debt free part. There was the emergency fund part. But really, when we looked at all of our different options, the risky, high return on investment, no risk, no reward element of our portfolio was our business. What was missing from our portfolio was that stability, that security, that thing that we knew this money was safe and could be there if we needed it.
Yeah.
And that, when we looked at those options, it was like a savings account with very little interest, a CD, but then you got to wait a year or two in order to access it, whereas whole life had this other element to it that made it immediately accessible and still safe and potentially growing more than just a savings account would, at least in 2013 and probably still today, depending on what kind of savings account you're using. So it wasn't, most people don't like whole life as an investment. We were not looking at it as an investment. We were looking at it as a safety, a security. Our investment, our high risk, high reward, hopefully was our business. Reward never actually came.
Well, we got some rewards.
Educational rewards, but not really. We didn't make millions of dollars or anything. And I would say we probably would have made more had we stayed in our comfy cubicles, but that's a different thing. So that's one critical thing for us. To boil it all down to a nutshell, the reason we chose whole life was for that stability and that transfer of risk and still having liquid accessible cash that was growing. Okay.
Yeah, a wealth stabilizer.
Stabilizer, yep.
Yeah. And so that was us personally, and we're still growing in it. We are doing multiple things. We want to increase our wealth. As our wealth is growing, we need a bigger base to stabilize. Yep. And we will make probably bigger risks and all of that. But it's, again, a lot of people get it twisted. It's upside down where they're risking more and then things happen. And that's actually what happened with your mom.
Yeah.
So
I'm going to get into that story.
Oh, okay. Okay.
So back in 1980, my parents did have whole life. So that's when they got married. I was born in 1984. When I was like 3 or 4 years old, so late 80s, my dad actually cashed in his whole life insurance policy, and they used the funds to go watch my brother graduate from basic training from the military. Really great experience. We still tell stories of driving down the interstate, and I had an Alf doll that was back all of the semis would honk at us because they saw this Alf, and my dad thought that was a funny looking dog. Great experience, but no life insurance except maybe through my mom's work, she might have had some coverage. And then in 2014, my dad got his wings.
Well, and let's back up a little bit. We were running a coffee shop.
Right.
And
I'm going to tell that part.
Right,
So just before then, my parents had moved in with us. We took them in and were caring for them, helping, cook their meals, do all the things. And when my dad graduated, all that my mom got was the little bit from Social Security that they give everybody, right? It's like $500 or so. And my mom then had to live on just her pension. She actually doesn't qualify for Social Security herself, things like that. So if she had to have been living on herself then, she wouldn't have been able to, right? And that's part of why they moved in with us, because they knew that something could happen to one of them. My dad had already had a heart attack and survived cancer. My mom had had a stroke. They had these health conditions that they were like, something could happen. In this moment, a few months after my dad had passed, he had always taken care of the money. So she now had this opportunity to make some decisions to decide how to best use the funds that she had. Mm-hmm. And she had a very little bit in savings from the equity they'd built up in their home before they sold that home to move in with us. And that was their emergency fund. And that would be gone like that if she got a disease where she needed to go into a nursing home or get some in-home health care, or even just a big emergency room bill, right? That wasn't covered by Medicare or was only partially covered by Medicare. And so when we started looking at what could whole life do for her, and actually what could any financial product do for her?
Yeah, we were looking at all kinds of things.
The thing we found about whole life was that the kind of policy we were looking at had what's called, the technical term for it is called accelerated benefits. And there's all kinds of different names that different life insurance companies have for this. But essentially, it allows families to access a portion of the death benefit for those kinds of needs, like a nursing home or in-home health care. So if let's say you have a $100,000 death benefit, you might be able to access $70,000 of that if you get diagnosed with cancer or Alzheimer's or something like that to help cover the expenses. And then your family still gets that other $30,000 when you eventually do get your wings, cover those final expenses, that kind of thing. So what was interesting for my mom when we started looking into it is she could take that amount that she had in savings and do a one-time transfer into the life insurance policy. She'd automatically get a greater death benefit and get these accelerated benefits that could help cover those things. Because that was really our biggest risk as a family, is if she needed those things, how were we going to pay for them? Her pension wouldn't cover it, right? It was barely covering her living expenses. Yeah. We'd have to not work. Our income would be decreased substantially if we had to do 24/7 care, right? Like that was our biggest risk as a family.
Grandma always said, eat your vegetables, look both ways before crossing the road, and never risk your financial future on elements of the market you can't control. That grandma, always good for some tried and true advice. And although some of her wisdom seems to have skipped a generation, you don't have to be left behind. Download Grandma's top tips for an independent financial future absolutely free when you visit grandmaswealthwisdom.com. Don't wait. Get Grandma's best tips today.
And we had already experienced some of that with your father. And that was one of our, biggest frustrations and regrets. I'm the son-in-law. He didn't have that set up for his wife. And I think that as a loving thing for your family spouses is to make sure that they are taken care of when you're gone.
Yeah.
This isn't just an investment vehicle. It's looking at what is your legacy that you're leaving, especially for females, because females typically outlive the males.
Right.
And
it's the female daughters that are often the ones taking care of the aging parents. It really, a big reason in her 60s why she chose whole life was to make sure she was able to care for herself and care for loved ones that might have to care for her, right?
Yeah.
Even if I did leave my job, like my work, and take time to take care of her, she could actually use that accelerated benefit to pay me so that I could still feed myself and pay my rent and stuff like that. So in a nutshell, that's the main reason. And in the meantime, that chunk that she put into the policy, she still has access to a majority of that. And within 3 years, typically people have access to all of it and then some. And so if she does have something where she needs to take out a little bit, and, she can totally do that. And not it's not going to totally collapse the policy. Okay. So that's my mom's story. Now we've got another family member that we want to share his story with whole life. And he was a little too young to choose whole life for himself, but it's really why we as a family chose whole life for him.
Yeah, we chose using whole life for our son.
So when he was 3 months old, when we finally were out of that fourth trimester, so to speak, we did the paperwork, we started the policy, and really the primary reason was so that no matter if he gets diabetes or cancer or any kind of thing, he's got life insurance that can't be taken away from him for the rest of his life. And it's a really low premium when kids are that young. And he's building up this cash value that he can then use, it's technically ours, right? The adults. So we have to do this for him, but we can use to help pay for his college, help him buy his first home, help him start his first business, whatever it is. And it's that little bit over time that starts growing for him and can be there for his future. And we can pass on to him to give him the ability to start saving when he does have that stable income for himself. And then he can use that to save for his own retirement, to help protect his kids and grandkids, to use throughout his life, as well as, provide all those other benefits that could be there.
Yeah. And the numbers are amazing as he gets older. It's mind blowing.
Yeah. So those are the three stories.
Yeah. Those are our three stories.
Three stories.
People have so many stories, and I would love to hear yours. Again, everybody is different, but I believe this is a wealth stabilizer that almost everybody, I think, should have, or at least consider it. Because
but let's talk about why not to, like, if you were going to go and talk to a whole life agent, right? Someone that sells whole life insurance, what are some red flags to look out for that you might want to think twice, okay? And these are, again, from our personal experience, why we would not have considered whole life for ourselves, for my mom, for our son. And we would have been like, no, run as fast as you can the other direction, okay?
Yep.
So the first one is zero cash value in the first year. If you're looking at the numbers that they share with you and you see a zero for the cash value in the first year, run away, at least in our opinion. That means that the person selling you the policy is getting a super high commission. You're getting the highest benefit they possibly can get you for the highest premium. The kind of whole life insurance that we found that really appealed to us, we had about 40% cash value, like of what we paid in, we had about 40% accessible from the first month, right?
Yep.
And through the first year. Now that's going to be different depending on your policy. You might have more, you might have less, but our first policies, that's how it was. And it's because of how it's structured, which we could do a whole video about good structure for whole life insurance. There's a great boat analogy and all of that. We don't want to get technical here. We're just telling some stories. But if you do see that big old goose egg in cash value, then you might be looking at the really old whole life that's more like a rotary phone than the more modernized whole life that have these special riders that help boost that cash value and get it going. Starting to get technical now, but that's number one, red flag. And that's the kind of whole life that a lot of people hate. And we hate it too. We wouldn't have chosen whole life if it was like that.
And I think that's the type of whole life that people would say, like the Dave Ramsey's or whatever, they're comparing that to what is now. And I think, again, as a person is thinking about this, you want to find the right people that understand and have the right framework.
Yeah.
Right?
So the second thing when they're showing you these data tables and things is if you look at the guaranteed numbers and you see the guaranteed go to zero at some point in the future, maybe when you're 70, 80 years old, what you're likely looking at there is what's called universal whole life or variable whole life. These are touted as doing the same kinds of things that the kind of whole life that we chose do. And in a lot of ways, they function the same. But their, again, structure is very different. They are actually structured more so like buying term insurance and then having a side investment vehicle. And these are the kinds of whole life that are very much more investments. They're putting your money at risk. You are actively following an index in the market. They might have some guarantees, but they also have really high fees. So you might be guaranteed a 1% interest growth on your investment side, but the fees and the different things that are involved can actually deplete that investment side really quickly. And that's when you look at the guaranteed numbers, you see that it does go to zero because those fees can increase over time. So be sure you're not just looking at the cash value at the beginning, right? And we got that, if you've got that goose egg That might be a red flag. But also look at that guaranteed cash value and guaranteed death benefit. See when they go to zero, and including if you stop making premium payments, right? Because eventually you might retire. You might want to stop making premium payments. Ask those kind of questions. What happens if I stop funding this? What are the guarantees? Those kind of things. And if you see that those guarantees disappear, that might be a red flag for you. That if those go to zero, you might be looking at an investment kind of whole life rather than a saving kind of whole life, or like this wealth stabilizing that we've talked about.
And again, it might have its place in somebody's plan, depending.
Same with the typical whole life with the zero cash value at the beginning. It might have a place for some people, but yeah.
And same with term insurance and other things.
Right.
It's just a matter of not everything, again, going into these videos, just watching them and saying it's all blanket statement. No, everybody is different, but I do think there is a guarantee that we will probably pass away. More than likely.
So the third red flag is that someone, when you talk to them, they want you to put everything into whole life insurance.
Or anything,
right? They want you to go all in on this index fund or all in on real estate, all in on, whatever. When we talk about whole life insurance, we always try to talk about it as a part of our portfolio. It's not the end all be all. It's the stabilizing part of our portfolio. And whenever you're going to work with someone who's going to help you develop whole life, we love that we got to work with someone who was looking at everything, right? Was looking at what are our hopes and dreams? What do we currently have? Where do we want our money to go in the future? What do we believe is going to happen with taxes? How much risk are we currently taking and how much do we want to be taking? All kinds of things like that are part of making sure that you're using whole life in the right way for you. How much of your portfolio should be there? If the difference between saving and investing and what kind of mix of that is unique for your situation. If all they're doing is trying to talk to you about whole life, sell you a product, they're not taking that holistic view, and you might get stuck with something that doesn't actually fit your unique circumstances.
Well, and even looking at that, based off of goals, based off of concerns, based off of all kinds of factors, really makes the person who's helping set it up decide what maybe is the best policy, best company, best all kinds of things. And so asking those questions is a very important piece. And so each strategy that we shared, or each story, personal story, they had different reasons and different outcomes.
And we actually have, even with life insurance companies, there are 3 different life insurance companies for each of those scenarios that we shared. So you want to be working with someone that can represent multiple companies. At least that's been true for us and been really good. And again, so if you've been following Grandma's Wealth Wisdom for a while, you might know that we talk about whole life a lot. And just to be totally transparent, we now are licensed life insurance agents in multiple states. And we do this as part of our thing, but we didn't choose whole life in order to sell it. We chose it for ourselves because it was the right thing for us from our perspective. And then we used it for about 5 years, and 4 to 5 years, and experienced all these benefits right away. And so when we were selling our former business and looking at how can we really help people, what's this next opportunity that we can make a difference in people's lives, we thought that's meant for us, how that can help other people. So that's why we got into this. But
it impacted our life.
I got to say one more thing about that. Even though we're licensed and we're brokers, we can represent multiple companies, you should take this video as just our stories. And you should dig in. Sure, go read those articles that hate whole life online, but also take a serious look. Hopefully you'll do that with us, but the only way to decide if this is right for you or wrong for you is to actually get a financial analysis, go through the process, find out what this could look like for you. Maybe it fits in now, maybe it fits in the future, but get that unique, personalized feedback. Don't just make a decision before you do that. And don't take our advice, or our comments, our story in this video as personalized financial advice. You need to work with a professional that knows your unique situation in order to do that.
Yeah.
Yeah.
I mean, I think you said a lot there. I think, again, the reason we got into this is because it made a difference for us. If we would have known like some of the haters and so much that's out there,
we probably would never have done this.
But again, I look at our economic climate and I look at where people are at now and saying, man, we have a lot of work to do. And how are we protecting the people we care about the most?
And ourselves.
Yeah. And I think that's a challenge. We are going to be facing more and more challenges. And again, we're going to be in more and more entrepreneur like spaces.
Yeah.
So how do we do that? And so that's part of why we created this.
And we'll catch you next time to help you break through to a smart, stable financial future using the time-tested wisdom of the greatest generation. The topics presented in this podcast are for general information only and not for the purposes of providing legal or investment advice. On such matters, please consult a professional who knows your specific situation.
This is thepodcastfactory.com.